Okay, everybody, welcome back, and thank you so much for being here for this very final session for the Fiduciary Investors Symposium. It's my pleasure to step in for Fiona Reynolds, the CEO of Conexus, to have this fireside chat with Mike Henry. Mike is the Chief Executive Officer of BHP, the world's largest diversified resources company by market capitalisation. He has over 30 years global experience in the resources industry, including both mining and in oil and gas. He's been with BHP since 2003, a member of the executive leadership team since 2011, and has held leadership roles spanning operational, commercial and technical. Prior to being appointed CEO in January 2020, Mike led BHP's minerals businesses in Australia. He's focused on creating exceptional value for shareholders and society through safely and sustainably meeting the world's growing need for commodities that are essential to improving economic well-being of people globally and to enabling the world's decarbonisation challenge. And that is what we're going to be talking about today. Welcome to you, Mike. Thank you so much for joining us. We know you have a very busy schedule, so thank you for making the time to speak to us today. As a child...
Thank you for having me.
Nice to see you, Mike. As a child, I actually grew up in Whyalla, so BHP played a big role in my history, so it's a personal thrill to be speaking with you today. We're going to start off this conversation with just some opening remarks by yourself about BHP's role in the energy transition. So can you just give a quick overview of BHP's activities in mine commodities, and then we'll go into some more specific questions.
Sure. So again, thank you for having me here today. I might start with a bit of context around mining and mined resources. As I'm sure everybody in the room is aware, the global economy is powered by the things that BHP produces and other mined resources in oil and gas. One of the things that sometimes gets missed is that the outlook for the demand for mined commodities is only getting stronger. So if we think about the world today, you've got about 1.3 billion people of 8 billion people on the planet who are in developed economies. You've got all the rest of the people out there who aren't living in developed economies aspiring to the same standards of living. And by 2050, the expectation is that about 5.5 of 10 billion people will be living in developed economies. So overall, 3.5 times increase in the number of people who are going to be enjoying the standard of living that we all enjoy. That has certain implications associated with it in terms of demand for copper, for nickel, and for other commodities, as well as for food. And I'll come back to that in a second. In addition to that, the act of decarbonization is a surprisingly metals-intensive effort. So the long and the short of it is that in order for the world to hit a 1.5 degree centigrade ambition, it's going to require about 2 times as much copper and 4 times as much nickel over the next 30 years, over the past 30 years, and surprisingly 2 times as much steel, which means more iron ore and more metallurgical coal over that period as well. To compound the challenge for the world, that supply is going to have to come from mines that are lower grade, smaller, in tougher jurisdictions. And so if left unchecked, the incremental mining activity that the world is going to need to undertake has the potential to lead to unacceptable outcomes by way of poor water steward or impact on water resources, impact on biodiversity, communities, and so on and so forth. Hence the challenge for all of us, be it those of us directly in industry or for capital markets, is to ensure that the system is working in a way that ensures that the world's needs for need for metals and other resources is met in the most sustainable way possible. So is being met by companies that set and uphold very high standards and continue to improve them. And for that to take place, whilst I think we've come so far over recent decades in terms of raising awareness around some of these challenges and making the system work more effectively, it is still not a system that's working the way that the world needs it to work, and we can talk through that a little bit further. But I do think that we're at a point in time where industry, capital markets, and other actors need to lock arms to figure out how we can go about accelerating the efforts to improve ESG standards and governance, and in doing so, ensure that the world's need for resources is met in an efficient way and a way that minimizes the downside impacts that might otherwise arise on other aspects of ESG than just climate.
So you talk about BHP being one of the best ESG credentialed mining companies in the world, and you're not here just talking about the type of commodities you produce, and of course, you mentioned copper and nickel as being important to the energy transition, but also how they are produced. Can you talk a little bit about that in an ESG context?
So it's definitely the how is so critically important. And I'll start by saying that whilst we do have a track record of taking a leadership stand on matters related to ESG, and I'd like to think that we've made some big inroads over recent years. We're not complacent. This is an area where our own understanding of impacts on the environment and so on, as well as societal expectations, continue to evolve. So we're always seeking to raise those standards, both within BHP but also across industry. Now, some examples of the how, and I think it's important to move away from just rhetoric and to some specific examples. I think our Chilean copper business is a great example. Only a few years ago, let's say 5-7 years ago, copper operations in Chile were being powered by coal-fired power. As many people in the room would know, copper mining and processing is a pretty electricity-hungry activity, and that electricity was coming from coal-fired power in Chile. Well before there was no push to do this on the part of shareholders, and certainly no requirements in Chile. We looked forward and we said, in the coming decades, decarbonization of our operations is going to become increasingly important. Recognizing that power makes up, approximately 40% of the Scope 1 and Scope 2 emissions that we have in BHP, we elected to go early, and we initially stimulated a gas-fired peaking plant to replace pretty much all of our coal-fired power in Chile. And within a few years, we had bridged from that gas-fired peaking plant, which gives kind of the stability to the grid, to full renewables. So within the next year or two, we will have fully moved from all coal-fired power a few years ago to all renewable power for our Chilean copper operations. That will reduce BHP's overall Scope 1 and Scope 2 footprint by about 15%. I would also note that in parallel with that, we spent about $4 to $5 billion in moving to fully desalinated water in Chile as well. And again, no requirement under regulations in Chile at the time. This is something where we looked a decade into the future and said, this is the right thing to do, and we started investing in it. And thankfully, we did that, because now this has become a more prominent issue in the public eye there. One other example I would give, Amanda, is on shipping. So recognizing the big footprint that BHP has in bulk ocean freight globally, and shipping contributes about 2% of the world's emissions, likely to go higher if left unchecked. We've sought to harness our purchasing power through working with ship owners to stand up the world's first LNG-fueled bulk carrier of a certain class. That's about 30% lower emissions than existing fleet, which uses bunkers. And we are going to make a strong push towards reducing emissions in the shipping of our products. So this is Scope 3 emissions for us, through the way that we harness our purchasing power and the way that we collaborate with ship owners.
We'll come to Scope 3 emissions in a moment, Mike, because I think that there's a lot in that. But you've also set a whole bunch of targets around your health, safety, environment and community, which were set back in 2018. And some of those target deadlines are fast approaching June 30, 2022. How are you faring against those targets? Are you going to meet those June 30 deadlines on those targets and longer term goals?
So if there's one thing that I'd like to think that BHP is pretty good at. If we set a target and turn our minds to it, we're pretty good at hitting those targets. So certainly, and I don't want to get ahead of our kind of public reporting, but yes, well on track for the targets that we've set out. And it does raise the point of the importance of targets or goals in some cases. Now, there is a certain philosophy that BHP adopts around these, which is that when we set out a target, it's not pie in the sky stuff. This is well thought through. We understand what's going to be required by way of resourcing. We don't always have all of the solutions, but we have a sufficient level of confidence to be able to put the target out there. And then we're, pretty disciplined about how we go about executing against that target. And the thinking there is that absent that, the more that we or other companies are allowed to put a target out, few years pass and we don't achieve the target, and we put that down to whatever external challenges. I think that erodes credibility, and so we want to make sure that whatever we put out there, shareholders and other stakeholders can have a high degree of confidence that BHP will achieve the targets that it's set out. And we'll talk a little bit about what that implies then in the Scope 3 space and the difference between goals and targets, perhaps a little bit later.
So, Mike, you recently demerged or sold your petroleum business to Woodside. I want to talk about this in the context of divestment, and that was good for your sustainability footprint, if you like, but it hasn't necessarily solved the overall problem in the real economy of that business. So, how would you frame that in terms of divestment? In terms of decarbonisation perspective across the economy?
So shareholders should give us no credit from a emissions footprint perspective for having divested our petroleum business, and that wasn't the intent behind the divestment. We've always been very clear that companies should not claim credit for a reduced emissions footprint as a result of divestment of assets, because all you're doing is shifting from kind of one owner to another owner. There's been no net savings in terms of global emissions. For us, this was all about kind of financial risk and returns. We knew that in due course, because we are so committed to achieving the aims of the Paris Accord, in due course, oil and gas is going to become a less attractive sector to be in or business to be in by way of returns and risk. So it was simply a matter of timing. It was a pretty capital hungry business. I didn't want to see us continuing to deploy capital into a business that over the long term, we didn't see as being, a core business to BHP. And hence, in looking at the various means of addressing that, the approach that we landed upon was spinning the oil and gas business out. We were very deliberate about choosing potential counterparties on this who we believed upheld good ESG standards, who believed in the world's need to address climate change. And through bringing our petroleum business together with Woodside to create a new Woodside, we end up creating a more resilient business that I believe is going to be better able to fund the energy transition for, in this case, Woodside shareholders and any BHP shareholders who've elected to hang on to shares in the new company, which is the majority of shareholders. So this new company, because it's larger, more resilient, is going to be better able to fund everything that Woodside is committed to by way of investments in business activities associated with the energy transition.
So minerals and metals that are vital for clean energy have relatively high or higher emissions, and you mentioned long-term and short-term kind of timeframes. What's the plan for the sort of shorter-term strategies to reduce these emissions? Obviously, over the long term, that's a different proposition. But in the short term, what are you doing to reduce those? So by way of background, BHP has a target in place for a 30% reduction by 2030 relative to 2020 baseline and net zero by 2050. Of our Scope 1 and Scope 2 emissions, about 40% comes from diesel being used in haul trucks, for example, 40% from power, and 20% are hard to abate emissions, things like fugitive methane from coal mining operations and so on. The easiest early win is in power. So we've moved to very significant, I mentioned the Chilean example earlier. We've done similar things in Australia. We aren't fully on to renewable power yet, but well on track on that. Generally not through building our own solar and wind farms, but rather contracting with others has been the bulk of our activity so far. And we've got further to go on that front. We're also working with others to stimulate the development of the technologies that will allow us to remove diesel from our operating sites. So these will be things like
trolley assist trucks. So these big trucks that we drive around on sites to move dirt and material currently run on diesel. We'll look to augment those trucks by putting in place a kind of an overhead tram system, which will allow the trucks to move on electric power. Or I know some of our industry peers are focused on hydrogen to move the trucks. We may ultimately look at removing trucks altogether and moving to in-pit crushing and conveying. But again, that uses renewable power. And so there's a lot of different technologies that we're looking at. We have to, just like I mentioned in shipping, where because we're a big player in the sector, we can harness our buying power to accelerate technological or development of the necessary technologies. It's the same when it comes to big equipment. So we're working with the likes of Caterpillar, Komatsu. We've even drawn in our industry peers like Rio Tinto and Vale and so on. It's something called the Charge On Challenge, which is a competition for equipment and technology providers to come up with the next big thing that will allow us to achieve these ambitions.
How so the room, this audience, Mike, is large institutional investors in Australia, both on the asset owner side, some of the country's largest super funds, as well as on the funds management side, all of whom I'm sure are your shareholders. How are institutional investors generally reacting to your net zero plans, your ESG credentials, and how are you engaging with them to communicate effectively around that?
So first of all, our shareholders have been very generous with their time and their feedback. So it's been encouraging to see the openness of shareholders to engage and work through what can be some very complex issues. We put forward a climate transition action plan. I believe we were the first, or at least one of the first major Australian corporates to do so, and that was at our annual general meeting last year. 85 or 86% support, so strong support for what we're trying to achieve. Having said that, of course, through that process, we were listening carefully for the feedback, and I think we set out that we were going to carry forward our strategy once every 3 years for an advisory vote. There was feedback from some that they'd like to see that more frequently, but the bulk of shareholders were supportive of the 3-year cadence. Broadly, shareholders were supportive of us having a climate transition action plan and an advisory vote on it. There was a cohort, and it was a small, certainly the minority, but not insignificant, of shareholders who were of the view that it wasn't something that we should be bringing forward to shareholders, because I think they felt that we were trying to place it all onto the backs of shareholders rather than take accountability for it ourselves, which of course couldn't be further from the truth. So we remain committed to bringing forward this with a regular cadence, and of course reporting on progress every year. I think the other area of discussion and debate at the time was around Scope 3. And we don't have a hard target on Scope 3. We have a goal on Scope 3, which is to become net zero. We have some very solid actions behind it. But in keeping with this theme that I mentioned earlier around, if we're going to set a target, quotes unquote, shareholders can rely upon us having thought deeply about it, understanding the science behind it, and being able to commit sufficient resources and capital and so on to achieving that target. And right now, for some of the commodities that BHP mines, there isn't a technological solution yet developed for our customers to be able to decarbonize their operations. And hence, it's one step short of a target. It is a goal, but that has since been kind of recognized or called out by the TPI as under their measurement methodology as well. But it's something that we'll, as we learn more, as we engage more, we'll continue to evolve our thinking on.
You've mentioned Scope 3 a couple of times now, and that's a challenge in reporting for investors and obviously also corporates. But can you talk specifically about the challenges for a global resources producer around Scope 3 emissions, particularly as we see policymakers, looking to link Scope 3 back to producers?
So look, there's a couple of challenges. One is obviously in the case of Scope 3, we don't own the investment decision required to if there's technologies available to decarbonize downstream operations, generally, well, the very nature of Scope 3 is that we don't have the ability to drive that investment decision. So it's about influence and engagement. Second of all, there is no, I think the world is still aligning on exactly how to measure and report on Scope 3. So there's still different standards out there. And then the third and biggest one is that the technologies in certain supply chains are not yet developed really to eliminate Scope 3. And I'll use steelmaking as an example of that. The world needs a lot more steel, as I mentioned earlier. And right now, it's not possible to meet all of the world's steel needs through green DRI. In fact, green DRI is still relatively nascent, or that's direct reduced iron. And the primary means of making steel globally still relies upon metallurgical coal. Now, we've sold out of some of our coal assets in the course of the past year, including metallurgical coal. And our thinking there was that steel makers will have to decarbonize in the near term. But because they don't have a ready zero carbon technology to deploy, they're going to have to decarbonize by making their blast furnaces more efficient and less carbon intensive. One of the means of doing that is to use higher quality coking coal. And therefore, in our portfolio, what we've done is we've consolidated our coal portfolio back to the best of the best coking coals, because we believe that in a decarbonizing world, or on the path to full decarbonization, demand for those coals will go up to support steelmakers' ability to decarbonize in the short to medium term.
We've had an interesting couple of weeks in energy markets here in Australia, and the unprecedented step of the takeover of the wholesale energy market, and the Energy Securities Board releasing a consultation paper that proposes a capacity mechanism to ensure sufficient energy supply. Some people have said that this is raised some concerns about keeping fossil fuels in the system. Do you have a view on this? What's your view?
So I'll give a broader view than just the Australian market, because this is, to some extent, similar debates are playing out in Europe, for example. I am on the record in saying that we believe that climate change is an urgent matter for the world to address. And we cannot end up in a situation where short-term considerations take us off path from kind of decarbonizing the global economy. Having said that, it has to be gone about in a way that is as efficient as possible and creates least unintended consequences in terms of economic impact on the energy poor, on things like, as I mentioned earlier, water stewardship, biodiversity, and so on through the act of mining. And the only way of achieving that is through well thought through policy and the various actors who are required to affect that policy coming together in a way that where we join hands and pursue a common set of measures. And I think one of the things we see playing out in various dimensions is unnecessary friction, because the right parties aren't coming together and working through some of these issues and figuring out how collectively we can move forward. And I mentioned earlier the point around mining, and if I look at the reliance that big shareholders currently have on service providers externally for understanding standards, for assessing companies against those standards, and so on, right now that is a very fraught exercise where as I said, there are in many instances not common standards. Different ratings agencies will rate companies differently against standards, and whereas for the markets to work in the way that we need them to work, or we being the world needs them to work, I think that between capital markets, industry, and some of these service providers or ratings agencies, for example, there needs to be a means of coming together, defining clearer standards, driving them to improve the quality of their assessments, and then all of everybody in the room there needs to be encouraging fund managers to differentiate more significantly between companies that are upholding high standards and companies that aren't. because that's ultimately what's going to drive the right behavior on the part of sector actors.
I guess kind of related, Mike, you've talked a little bit about, all of the resources needed for this climate transition, and analysts have talked about a resources super cycle that's, related to the climate transition and all of the infrastructure that needs to go into that. But we've also got this issue of a resources company's social license to operate. And there's, the contradiction between those two things. How seriously do you take that around the board table, around your executive team discussions? I mean, is that front and centre for you?
Oh, well and truly front and center. I wouldn't want to put a kind of a number on the split of time on board discussions on this, but it would suffice it to say it would be at least half in terms of the discussions that we have around the board table. And even for those things that some people might classify as business, kind of classic business discussions, social value permeates through all of those discussions. And it's one of the things that we've tried to make a defining feature of BHP and a competitive differentiator for us, is that for us, social value isn't something that hangs off on the side as a kind of adjacent function or business in BHP. It is through every single investment decision that we take. It's within our capital. It's in our capital allocation framework. In fact, Caroline Cox, one of my team, is going to be presenting to the market, I think it's in the next week or so, on the latest, our latest progress when it comes to social value. So this is really front and center for us. Through the COVID period, we were, hopefully able to demonstrate that even more tangibly in the actions that we took to support communities, employees, including employees of others who were because other business had an even tougher time of it. We were able to bring some of those people on in a temporary capacity, and then once we were past the worst of COVID, those employees moved back to the prior organizations and so on. So yes, it's really important, both in terms of what we do with communities and so on, but also on the broader ESG front, as I mentioned earlier. We've, for at least a few decades, in fact, it was one of the things that drew me to BHP initially. We've been very clear about our values, what we stand for, and then we stand behind them.
I guess kind of related and certainly a big S issue in the ESG conversation is, employment of people, and in particular when we come to the Mount Arthur coal mine and your plans to shut that down. And I've been asked to ask a question from the CIO of Mine Super, what your plans are for those 2,000 odd people that are employed there.
So and I'll be transparent, we're still working through it. We do understand it has to be a collaborative exercise. So we don't want a classic case where, people sitting in kind of the tower here in Melbourne figure that we've got it all figured out and this is the solution. So there will be a very collaborative process that's gone through with employees, ourselves, government, unions, and so on, to figure out how we can best support employees. Now, I should also note that there will be ongoing employment associated with rehabilitation, which is another, 15 years beyond mine closure. So it's not like all activity ceases day one. Having said that, we do intend to be very proactive in helping workers to retrain for other careers, potentially elsewhere in BHP, but with other companies and so on. I've found that in the Hunter Valley in particular, it's a pretty nice place to live. And more often than not, people would like to remain close to the hunter. But we'll be working with others to put in place the right support mechanisms to ensure that people are ready for that transition. It's not just employees, communities as well. We have a certain accountability to work with local communities, the Shire and so on, to help the community transition as well, recognizing that Mount Arthur coal does have a pretty big footprint in Musselbrook and the surrounding region.
So we've got about 15 minutes left, Mike, from our allocated time. I'm going to open it up to the floor to see if any of our investors have questions for you. Does anyone want to ask a question? Yes, please. Table 2.
Hey Mike, it's Brendan Casey. I'm a consultant in super, and thanks for your time today. It's great to hear your views, etc. I'd be interested in your perspective on the impact of the war in Ukraine on BHP, both I guess generally and also in terms of your movement to a more sustainable company.
Yeah, thanks for the question, Brendan. So first of all, BHP didn't have any investments in either Ukraine or Russia. We didn't buy anything by way of goods from there, and we didn't sell anything there. So the kind of that first order impact on BHP has been less than it's been for some of our peers or for other industries. Having said that, we've seen what's happened in commodity markets as a result of the war in Ukraine. Without a doubt, we see higher inflation in the near term because of the increased cost of energy. And we've seen higher prices for some of the commodities that BHP produces, like coking coal, like we're not producing potash yet, but we've obviously got a big investment underway in potash right now. So it has, it does flow through to higher inflation and an impact on the cost line. But one of the things that the ambition that we've set out for ourselves, and I think you've seen us demonstrate over a number of periods now, is to do a better job of containing the inflationary impact on the cost line than others in the sector, and that remains our commitment. But then in terms of the price outlook, we're not banking upon current very high levels of prices continuing on ad infinitum. Generally, what happens in a situation like this is you'll see a shock to the system, but then the system finds a means of coping with it and moves back to a measure of equilibrium. And the question is just how long that takes. But I think, Amanda, you mentioned earlier some talk of the super cycle associated with metals for renewables. We're in a cyclical industry, and if there's one thing that we've learned over time is the minute that people like myself start talking about a super cycle is the time when things are going to come back down again.
Any more questions? Yes, please. Table 6.
Thank you, Mike. And this table has many questions, so I'll start with two. My colleague will start another one. Jingming Qian from a trustee director of Clubhouse Super. My question, the first one is, Australia now has a new government, and China is one of your major markets. So what do you think about the future of Australia-China relationships, at least in the near future? And what could Australian organizations like BHP do to support a healthy relationship? Second question is, what's BHP's plans to manage the tax autonomy challenge in the climate change era, especially the European carbon tax, border tax?
Okay, so two big questions. Look, so the question about how do we see the Australia-China relationship in the near future, and then what companies like BHP could be doing about that. I hope for both countries' sake that the relationship gets back onto a more constructive footing, because without a doubt, we would not be the country that we are today, and we would not enjoy the living standard that we enjoy today if not for the economic kind of miracle or growth that's occurred in China over the past few decades, and the role that we've been able to play in that through exports of resources as well as other goods. And I think we do need to recognize that. At the same time, on the China side of things, I think it would have been much more difficult for that growth to have been achieved without steady, secure supply and economic supply of resources from Australia. So it has been in both nations' interests for that trade relationship to be strong. That will remain the case going forward, because China will continue to grow. The other thing I would note is that if you look at the Australian economy, roughly 25% probably would be maybe 30% would be exports. Of those exports, about half going to China, and so a fractious trade relationship there, is going to pose longer term challenges to the Australian economy, particularly against the backdrop of decarbonization, where oil, gas, thermal coal, metallurgical coal over the longer term are going to be a much less a smaller part of the economic pie in Australia. Iron ore prices will retrace, and even the education sector may not be quite as strong over the long term here. So at a time when Australia needs to be developing alternative industries to take up the slack that will be created over the long term, I think it's pretty important that we have constructive relationship with our with the biggest market. Now, what can companies like BHP be doing? One, maintaining a solid business relationship. So even through all of this period of kind of government to government tension, the business to business relationships have never been better, and even to some extent the business to government relationships. And so kind of the day-to-day interactions on the business front and businesses' engagement with China has remained healthy and strong. We need to continue to focus on that. And finally, we need to be sharing our perspective on what's happening in the economies, perspective on business with both sides openly and freely. And that's something I've certainly tried to do over the past year or two as we've been in some of these more difficult times. Your second question was around carbon taxes and how those play out in a differential way around the world, and what it is that we're doing to get ready for that. Probably three things to mention here. So one is ensuring that we're part of the debate and that we're able to provide a perspective on how you marry up the need for business to remain competitive and for the world economy to work efficiently with the concurrent need to decarbonize. So, policy in this space has to be very thoughtful. For us to do that, we have to be a credible actor. Being a credible actor means having well thought through positions, and most importantly, to be seen to be taking action on decarbonizing our own business, and for that to be recognized externally. And then the third one, of course, is staying close to the policy that's developing and figuring out what the implications are for our own portfolio, where the risks are. Does that have implications in terms of where we want to grow, where we want to deleverage in the portfolio, and so on?
Scott, did you have a question?
I do. Mike, Scott Tully from Colonial First State. Thank you for your time today. Building on that question on tax, and there's increasing commentary around resource rent tax or super profit tax on resource extraction, sort of a bit of a flashback to the Henry Tax Review of 2010 or whatever, which had interesting consequences at the time. So there's this question about the sharing between business and government of the revenues that come from resources, but also with inflation and the allocation to labour and the costs that come to your business and the scarcity of labour at the moment. How are you thinking about those sorts of issues from a shareholder perspective?
So let me address the labour one first. Now, obviously, in a world where the companies always have to be responsive to supply and demand. That's kind of free markets, and if you've got tight labour supply, you pay what you need to pay to get the skills that you need. And there's no issue with that. I think that one of the challenges the industry has faced historically has been that is the ratcheting effect. So with the way that the industrial relations framework operates here, labor rates tend to go in one direction. And the way that companies have then sought to deal with that, I think, has led to other unhealthy outcomes by way of workforce casualization, for lack of a better word, because in order to stay competitive and to maintain market rates, what's happened over time is the workforce has gradually become less a directly managed workforce and more has gone to labor hire and service contractors. Now, you will also find that some workers prefer that flexibility, so it's not kind of a totally black and white situation. But I think that the way the industry has operated in times of labor shortage has led to unintended consequences. Now, just to help frame the numbers here, in our business, for somebody driving a truck on a enterprise agreement, all in probably between $150,000 and $200,000 per annum for driving one of these big trucks. You would find maintainers would be a little bit above that. For casualized labor or labor hire and service contractors, you might be looking at 100 to maybe 100, somewhere between $100,000 and $120,000 per annum. So these aren't low numbers. But having said that, again, I come back to the principle of supply and demand. And if demand's high and supply is constrained for whatever reason, then we have to be willing to reflect that in the rates. Now, just on the point of the workforce, coming back to the earlier discussion on social value, we did elect a number of years ago to begin addressing this point of having, the workforce having become too skewed to less than permanent work. And so we stood up an entity called Operations Services, which is providing people with permanent work, now has probably circa 4,000 people in it here in Australia. So 4,000 people who were previously labor hire or service contractors, now with permanent jobs in operations services. And we want to take that further. So I've said that I wanted to go from 30 to 40% of the BHP workforce in Australia who is permanent to 60 to 80% of the workforce that's permanent. And we're well on track towards that. Not just because I believe it's the right thing to do. I also believe it's going to make us a safer, more productive organization, because we'll have employees there who are committed to BHP for the long term, where we can invest in their training and they'll be more engaged because they'll feel that connection to the company. And that has to be a good thing from a safety and productivity perspective. Now, you also asked about kind of rent seeking or sharing of rent amongst actors. Look, and you see this come with the cycle. We've seen it many times in the past. It's a difficult one because you wouldn't be surprised to know that we think as a company we already contribute quite a bit to the states and nation. And if you looked at the numbers in terms of the proportion of government revenues that come from the resources sector, either through royalties or through corporate tax, it's astoundingly high here in Australia, which I think is, the more that can be done to diversify the economy over time, the better. We have worked previously, if I come back to the Queensland situation, which is very live, we've worked previously with government to co-fund things that will help the broader economy, like infrastructure and so on. We were willing to do that this time around. In fact, we also put forward and we're a concept around working together to fund new industries like technology and so on. So helping with the longer term transition of the economy, but that wasn't to be. The challenge that I think we see and that everybody around this table should also be aware of, it's actually two challenges. One is by not having stable fiscal policy and the terms being able to be changed on a whim, it makes it very hard for companies like us to make big investments. I contrast that with Canada, where the government there has been very welcoming of mining investment, has gone out of their way to kind of draw us there. In fact, has co-funded a little bit of the investment in potash and knocked back a proposed royalty increase. Well, not surprising then that we're investing $7.5 billion in a Canadian dollars, $5.7 billion US Canadian potash project, because we've got greater confidence about the terms of the investment longer term there, where given what we now know, it would be almost impossible for us to make any major investment in Queensland in the near term, because we wouldn't know what our returns are going to be. And by the way, the Queensland was already the highest, but they are kind of totally out of the ballpark now in terms of the, between corporate tax and royalty rates, well and truly higher than any other jurisdiction in the world. So that's one challenge. Second challenge is that many of your clients, and notwithstanding the statements that have been made about this isn't going to impact Queenslanders and it's just foreign shareholders and so on, that's not the reality. The revenue raising within Queensland will mainly flow to the other states because of the horizontal fiscal equalization mechanism in Australia. But shareholders are going to feel this directly in terms of lower share price, reduced dividends, and so on. Less so, I mean, because we're a big company and we've got other businesses, the effect is more muted. But if you're a shareholder in a junior company, a Queensland shareholder in a junior coal company, for example, yep, you look at what happened yesterday with share prices, and they'll definitely be feeling that. So the downside impact is not small for shareholders. And I would argue that the positive impact in terms of the amount of the revenue that gets retained is probably not quite as high as it might appear at the headline level.
Mike, we're just about out of time, but I spoke to my father this morning and told him that I was stepping in for Fiona and having a chat with you today. He's been an investor in BHP for more than 40 years. And I said, what do you want me to ask Mike? And he said, is the current dividend policy going to continue?
Yes, indeed, it will, and I hope that shareholders have seen the benefit of that dividend policy in recent years, which kind of puts the chocks under the wheels with the 50% minimum. But in the clarity we provided around the capital allocation framework, it kind of drives us towards a certain set of outcomes for shareholders, and long may the good times last.
Mike, you've been extremely generous with your time and your information. Thank you so much for sharing your plans, and best of luck. Please thank Mike Henry.
Thank you so much.